afternoon, everybody. First and foremost, apologies for the delay. I'd like to welcome you all to the session of the Monterey Policy Statement for August 2023. I'll start by introducing myself and the BOU officials before you. My name is Kenneth Egesa. I head the Communications and Public Relations Department. Before you is the Deputy Governor and Acting Governor, Mr. Michael Atingi-Ego. You're most welcome. We have Dr. Adam Mugume, who is the Executive Director, Research and Policy. Dr. Adam Mugume, you're most welcome. Thank you. And we have Mr. Hannington Waswa, who's standing in for the Executive Director, Supervision. Mr. Waswa, you're most welcome to this session. In terms of the House rules, I'm requesting you to switch off your mobile phones during this session or put them in silence. We will have the reading of the statement. After the reading of the statement, we'll have a question and answer session. We will begin with questions coming from this conference room, and then we'll take on the questions from Teams and from YouTube and other online channels. Then we'll have, after that, a session in Luganda, and we'll alert you of any other occurrences after that. I think with these brief remarks, I will now invite the Acting Governor, Deputy Governor Michael Atingi-Ego, to present the Monterey Policy Statement. Thank you.
Yeah, thank you very much, Kenneth. And a very good afternoon, our viewers and listeners. Listeners, welcome to the reading of the August 20th, 2023 Monterey Policy Statement. On 15th of August 2023, the Monterey Policy Committee, MPC, lowered the central bank rate to 9.5%. After peaking at 10.7% in October 2022, inflation has steadily decreased to below 5%, faster than projected. Annual headline and core inflation dropped to 3.9% and 3.8% in July 2023, from 4.9% and 4.8% in June 2023, and this is respectively. Similarly, food crops inflation declined to 9.3% in July 2023 from 12.3% in June 2023. The deflation of energy, fuel, and utility costs was negative 1.6% in July from negative 3.1% in June 2023, and services inflation averaged 3.1%. In inflation was due to tighter monetary and fiscal policies, strengthening of the Ugandan shilling exchange rate, lower energy and food prices, improved global supply chains, and reduced domestic demand. Also, the drop in inflation was driven by base effects, as the prices are now lower than they were at the same time last year. This downward inflation trend is predicted to continue in the coming months due to lower international food and fuel prices, better agricultural supply, and decreasing inflation expectations. Although the global inflation remains relatively high, it is getting closer to the targets set by central banks in advanced economies. The international trend could help reduce domestic inflation pressures. However, advanced economies will likely maintain tight monetary policies, which might cause currency volatility as foreign investors in local markets seek high returns abroad. Nevertheless, the exchange rate is expected to remain stable. There are still risks despite improvements in the near-term inflation projections compared to June 2023. On the downward side, global inflation might continue to decrease, potentially affecting domestic inflation. A significant global economic slowdown could also impact inflation by reducing global demand, leading to lower prices for goods and commodities. On the upside, external risks could drive inflation higher, as well as their exchange rates. Also, adverse weather could keep food prices elevated. On the balance, the Monetary Policy Committee assesses that the risks to inflation outlook could result into lower inflation. Uganda's economy has demonstrated a resilience and has been recovering well despite the uneven global growth environment, with estimated growth of 5.3% in 2022/2023. However, economic growth seems to be slowing down due to weak demand. The Uganda Bureau of Statistics, that is UBOS, data show quarter-on-quarter average economic growth of negative 6.5% in the second and third quarters of 2022/23. The agriculture, industry, and services sectors all posted negative growth rates in the activity. Private sector credit growth was moderated amidst tightening bank lending standards. In addition, high-frequency economic indicators pointed to weakening growth momentum during April to June 2023. Looking ahead, economic growth is expected to recover gradually, ranging from 5% to 6% in the fiscal year 2023/24. Private sector consumption, investment in extractive industries, and improved exports are anticipated to drive this recovery. The outlook for the domestic economy is subject to a range of uncertainties. The first one is that economic growth in advanced economies are posing a risk to domestic growth. It is possible that higher policy rates in these economies could interact with long-standing global financial vulnerabilities, such as elevated levels of debt, to significantly slow the global rate growth. Secondly, weaker foreign demand could restrain export growth, resulting in a deteriorating current account deficit and higher external financing needs. Thirdly, a resurgence of supply chain distortions due to geopolitical factors. Fourthly, a tighter fiscal policy, in part due to unfavorable global financial markets, could also restrict government development expenditure. And lastly, moderation of household expenditures, in part due to the lagged effects of a decline in real incomes, weakening of prices for commodity exports, and a reduction in agricultural output as a result of unfavorable weather conditions. The MPC noted that the materialization of the downward risk to economic growth could lead to a sharper decline in GDP growth. The current economic forecast suggests that economic activity remaining below capacity over the next 2 years will exert further downward pressure on inflation. In light of this outlook, the MPC decided to lower the CBR to 9.5%, aiming to stimulate economic activity while maintaining inflation around the target. The CBR bands remain at plus/minus 2 percentage points, and the margins on the CBR for rediscount and bank rates stay at 3 and 4 percentage points respectively. As a result, the rediscount and the bank rates are now at 12.5% and 13.5% respectively. In addition, the cash reserve requirement, what we call the CRR, has been lowered by 50 basis points to 9.5%. The Bank of Uganda will closely monitor economic developments and inflation prospects to take appropriate actions for sustainable macroeconomic stability. The MPC also noted Uganda's progress in strengthening anti-money laundering, financing of terrorism, AML/CFT. In February 2020, the Financial Action Task Force, what's called FATF, placed Uganda among jurisdictions under increased monitoring, referred to as the grey list, due to the strategic deficiencies in AML/CFT. Accordingly, the Ugandan authorities agreed with the FATF to implement an action plan to address the deficiencies. Specifically, the Bank of Uganda was required to address 6 deficiencies relating to immediate outcomes, what we call IO, 3 and 4 of the FATF standards. Following continuous engagement with the FATF since May 2020, as at 30th June, Uganda had largely addressed 20 out of the 22 FATF required or agreed actions. The remaining 2 action points are being addressed. That marks the end of the reading of the monetary policy statement for the month of August 2020. I thank you for your very kind attention.
Thank you very much, Deputy Governor, Mr. Michael Atingi-Ego, for the statement. We will now go into the Q&A session. When you're given the floor, please mention your name and the media house you're representing, and then let's go into the questions. Yes, please.
Thank you so much. I'm Ivan Tivenkana from Smart24 TV. From the governor's speech, I picked out a couple of interesting areas. One is the strengthening shilling. And right now we are looking at World Bank's financing. Obviously this comes with a dollar shortage. Does it have any impact on our coffers? Then 2, it's in regard to the 6 deficiencies that BO addressed as per FATF. What deficiencies are those? Would like to be informed about them. Then still, we are looking at the reserve requirements dropped by 9.5%. I would like to know how valuable is this to the financial sector? I think that's it.
Okay, we will take those questions, those 3 questions, and then come back for other questions.
Regard to gold, as per FATF, maybe you'll put me right. One of the concerns has been regard to the transparency in the extractives industry, and gold is one of those. So I'll be interested in knowing how critical is it in regard to tracking down the import-export movement of the commodity.
Okay, so we'll take those questions first and then give you an opportunity to ask other questions.
I have colleagues here from different directorates, research and supervision. I will just say something small, but then they can add the details to what you've raised. Now, on the strengthening shilling, yes, I did mention the fact that one of the factors that has led to a faster decline in inflation relates to a stronger shilling, because the shilling has been performing as strongly as you're all aware. Now, you talked about the impact of the World Bank on this. Look, until we get a firm information from the Minister of Finance regarding the exact amount of the resources that are affected, it would not be proper for me to speculate on what the impact is going to be. And also we want to know how is the Ministry of Finance going to respond to whatever cuts have been made. My understanding is that most of these cuts relate to projects that are yet to be approved by the World Bank. So it therefore means that maybe they have not yet been budgeted. All right, for if they're in that are budgeted in 23-24, we need to know how much they are, what, and what does the government plan to do next. Then we can properly make an assessment of the impact of that on the shilling once we've known how government is going to respond to this cut. So right now it's difficult for me to say in affirmative what's going to happen until I have that full information. But nonetheless, you're aware of the fact that last week we saw the shilling lose strength as a result of this announcement. We have a market determined exchange rate and a number of factors that that also determine the movement of the exchange rate. There are things like sentiments, information that comes in. So the markets tend to play on that. But you're aware that Friday and yesterday, the currency kind of like picked some strength. Yesterday, that strength increased a bit. So we do not know yet whether that's going to reverse. But certainly, as a central bank, we will do whatever it takes to stabilize the exchange rate. And by stabilizing the exchange rate, I don't mean that we are going to lower it or that we are going to strengthen it. Whatever the fundamentals will dictate that will be, we will maintain it around there, because we only go into the market to ensure that there is stability in the market. All our measures are aimed at ensuring stability in the in the exchange rate. And like we've demonstrated in the past, we have what it takes to stabilize the exchange rate. Then on the deficiencies that I talked about, I think I'm better off having the executive director of supervision talk to that regarding the what it means for Bank of Uganda and what this is specifically. And then on the cash reserve requirement, yes, it has been lowered by 50 basis points. You recall that last year, I think sometime in June, it was raised by 200 basis points from 8% to 10%. And it has been so. Now we've lowered it by 50 basis points from 10% to 9.5%. Now we expect that to add liquidity into the system. And like we mentioned before, that we are seeing that economic growth is slowing down. And we hope that by doing so, we are adding liquidity into the system. And also with the lower CBR, that should have an impact, overall impact in lowering the lending rates. And with lower lending rates, we anticipate that the private sector credit activity will pick up. So let me give my colleagues the chance to respond to maybe more on the CRR and the gold. That will be the executive director of research. And then the EDS will talk about the deficiencies specifically to Bank of Uganda. EDR, please.
Thank you, DG. Yes, as DG rightly put it, reduction of CRR and CBR, a combination of the two, eases liquidity conditions in the domestic financial markets. And therefore, it means that the banks ideally would have more liquidity available to lend. So, for example, if we just do back of envelope calculation, reducing the CRR alone by 50 basis points would mean that you're injecting, looking at the deposit available, the deposits in the commercial banks, we are talking about an injection of around 160 billion Uganda shillings, just on back of envelopes calculation. So that liquidity, in combination with reducing CRR, which also means that the banks now have more liquidity, we believe that that will have some impact on liquidity available to the banks for on lending. It may not be immediate in terms of lowering lending interest rate, etc., but at least as it should be able to ease the liquidity available to the banks, which then can be available for on lending. So we believe that that is the right direction, given that the demand is softening. Related to gold, actually the information we have, apart from the firm that was blacklisted, the gold is gold exports and imports in Uganda are well marked by UN standards. It is only one firm, the ownership, that was queried, but to the best of our knowledge, gold has no issue in terms of the classification. So I think the firms that are involved in exporting and importing have adopted UN standards in terms of classifying the origins of the gold and where the gold is exported to. Thank you, Chair.
Thank you, Governor. Regarding the six deficiencies that were highlighted by FATF, previously what we used to do when we were conducting on-site examinations of financial institutions, that is commercial banks, credit institutions, microfinance, deposit-taking institutions, forex bureaus, and money remitters, we would do an exercise that is all-encompassing. You look at all the risks in each of these institutions when you go on-site. But when we had a national risk assessment exercise by FATF, they felt that we needed to separate the anti-money laundering risk out of the other risks. So they gave us recommendations that we needed to implement. And they are: one, as a central bank, you need to set up a special unit that deals with anti-money laundering. They do examination, AML-specific examinations in these institutions. That has been set up. We also needed to set up guidelines that we use as the central bank to review the AML policies and procedures of these institutions. It's not that we didn't have them, but we had them as part of our operations manual that we're using. So we had to separate it and enhance it further with the guidance from FATF. In addition, they wanted us to have a risk-based framework that we use to supervise financial institutions. Then, because this was coming out as a new risk, we had to create awareness among the members of senior management and the board of directors of these institutions, so that they get to know exactly where we're coming from and what the expectations from their end is. Then, in the unlikely event that the recommendations or directives that we issue to these institutions are not followed up, we were required to come up with a penalty regime that would be proportionate and dissuasive, so that it would help ensure compliance with the directives that will have been issued by the central bank regarding AML and CFT. Thank you very much, Governor.
Now going to other questions. Who's ready to come on board?
Dennis, my name is Dennis, work for the city. Mine is about, of course, there's word on the street that the Bank of Uganda is about to phase off the 1,000 old shilling note. I don't know if it has reached you, because people have an interest on this and want to know how soon is it going to be done, and what has prompted the Bank of Uganda to get the old 1,000 shillings out of circulation, and is it also going to, when you phase it off, as what you've been hearing, are we still going to have the 1,000 coin? Thank you.
I think the issue here is the coining of frequency it rarely comes back to the banking system. By the time it comes back to the banking system, is mutilated and what have you. So you find that the replacement ratio of these notes is very, very very high and therefore expensive. Whatever you deposit in the, into a commercial bank and is later on brought to Bank of Uganda, most of it ends up as being cancelled, and yet printing of the currency notes is the cost of printing is very high. So we believe that coining might offer a better solution than printing, than the continued printing of the paper notes. So I'm not very conversant with the timetable for that, but I think the plan is just to coin the 1,000 as a cost reduction measure. But maybe, Idia, you have something to add.
No, actually, I don't have anything to add. What I know is exactly what you have said. And the timeline, we are just starting the process. The design, after the, the policy is approved, then you start the process, the procurement process, the design ZTC, which will take a while. So I don't think we have a timeline at the moment, as I don't analyst came out recent, but at least in my understanding that we're just starting the process. No, they shouldn't be in a panic at all. So the coin, even if the coin was to come, it will move, together with the note until further notice when the notes are completely, slowly by slowly are completely withdrawn. Yeah.
We have some questions coming in through social media. Oscar Nyejema from Makerere asks how prepared we are to counter any effects of the World Bank's decision to our currency and how this is most likely going to affect import prices. We also have Charles K on Teams who asks, can the DG please share some insights on the Forex reserves position? We'll take those as we wait for other questions to come through.
So what is the name of the...
Oscar.
Okay. Yes, thank you, Oscar, for your question. Again, like I mentioned earlier on, until we get more information about how the Ministry of Finance is going to react to this, whether they had really budgeted for this money or not, it is difficult for us right now as a central bank to make a comment on that. But we are working with the colleagues in the Ministry of Finance to get that information, and then that information will better place us in how best we can respond. But fundamentally speaking, we know that aid to Uganda is one of the fundamental factors that affects the exchange rate. At least when the aid is cut and has been budgeted, and it of course means that there are a number of scenarios that one can consider. Either you cut the budget, or you replace the financing with more expensive financing, or you could even do net domestic financing, issuing more government securities in order to replace that. But of course, it does come at a price. Now, importantly, if the aid from the World Bank was coming in hard currencies, such hard currencies would have contributed to the build-up in the reserves of the central bank, and then we would give the government the shillings in exchange for that. So it would contribute to the building of the reserves. So depending on the import content of that project aid that we're expecting from the World Bank that might have been cut off and cannot be replaced, then it might slow down the rate at which we can build up the reserves. And what does that mean for the currency? Of course, investors look at the reserve levels and they make an assessment on that. And in the past, we've seen aid cuts leading to a depreciation in the currency because it's a fundamental. You cannot fight against a fundamental. That is, you can't lean against the wind. If something is really driving the exchange rate, which is fundamentally important, it is better to allow the exchange rate to adjust rather than to try to defend it. Because in trying to defend it, you might end up losing your reserves. But again, like I said, as a central bank, whatever the fundamentals will lead to the change in the exchange rate, we will ensure that the exchange rate remains stable at whatever level the fundamentals determine it to be. That's what we mean by market exchange rate, determined exchange rate. But right now, whatever we are seeing out there is just a speculative behavior by the market. We have been informed that this aid cut is for projects that are yet to be approved by the World Bank. So it's very likely that a majority of them have not been budgeted for. So we are waiting for that information before we can give a firm answer. The reserve positions, as I speak right now, is anywhere close to about US $4 billion. I can be corrected by EDR on that, but it's close to about 4 billion. Recall that our reserves had come down to about 3.5 billion some time back, but towards the end of last financial year, we were able to rebuild the reserves, largely because Bank of Uganda resumed purchases of foreign currency from the market. I think by the end of last year, we had bought north of $250 million from the FX market. Notwithstanding the difficult global environment, the policies we pursued allowed more inflows to come into the economy, and we were able then to buy more. And that also explains why the currency was appreciating. So we took the opportunity to buy more reserves. And then also we had some budget support funds coming in. The IMF completed the fourth review of the ECF, and some money came in through that. And then also we had the budget support from some of the, from some of the creditors, which helped in rebuilding reserves. So that's where we stand on the reserve position.
Hand of Razia Khan on Teams. Razia Khan, please come through.
Very much, DG. My question is around the slowdown in the economy that you alluded to. I'm sorry for the echo, but could you share a little bit more insight into the factors that may have led? Is that as Uganda gets closer to becoming an oil producer, we are going to be seeing an acceleration in growth. When would you expect that turn to come?
Thank you, Razia, for that question. I think the slowdown can be attributed to a number of factors. One, we've been pursuing a tight monetary policy, and so has government been undertaking fiscal consolidation. Now, we know that the transmission mechanism of monetary policy in our case is anywhere between 12 to 18 months. So some of the actions we took last year are now beginning to play out. So that is affecting the, the aggregate demand in the economy. If you look at the private sector credits, private sector credit growth by end of June was only 6.5% compared to where it used to be of somewhere near 10%. So we think that the impact of this has been to tighten the credit conditions, notwithstanding also the fact that most of the financial institutions have become, sort of like risk averse, given the fact that the quality of the assets has been affected by the COVID-19. They have had to make some provisions against that. And then also, beyond that, we of course know that in certain sectors like agriculture, the value addition component in that sector kind of like declined, but we hope that this is going to reduce now that we have had some harvests. So there will be some inputs that are going to contribute to further value addition, and that is expected to raise the GDP going forward. Now, in terms of where we see growth going, like we mentioned, based on our estimation, growth in 23-24 is going to be anywhere between 5 to 6%. But the government objective is to have it at 6%, somewhere close to 6%. And that's why we're taking these policy measures, that how can we ensure that notwithstanding what we're seeing now, we remain close to 6%, which is the government objective. So we think that by lowering the CBR and also lowering the CRR, we are creating conditions that are going to support growth to be closer to the 6% government objective that we talked about. So I don't know whether you have anything to add to that.
No, I don't have anything to add.
Okay, who wants to go next? Are there any more questions on? Okay, so let's go to. We have Charles Katongle on MS Teams, and he says all the rating agencies currently have Uganda's outlook as negative, citing reduced availability of concessional external financing, higher domestic and external financing conditions, and a large twin budget and current account deficit. What are your views on the country's progress in this regard?
So,
I will repeat the question. This is Charles Katongole, and he says all the rating agencies currently have Uganda's outlook as negative, citing reduced availability of concessional external financing, higher domestic and external financing conditions, and a large twin budget and current account deficit. What are your views on the country's progress in this regard?
okay, thank you, Charles, for raising that question. Yes, you're right that all the credit rating agencies changed their outlook for the Ugandan economy from stable to negative, although the overall rating did not change. And the reasons that you cite for that change are correct. So I think what we need to discuss is what has the government of Uganda done since then? Look, concessional financing has become hard to come by because apart from the international financial institutions that provide this concessional financing, we also used to get concessional financing from bilateral partners. But you're aware of the fact that the COVID-19 impact, the impact of the Russia-Ukraine war has affected the fiscus of most of these bilateral creditors. So therefore, we are not getting as much concessional financing from the bilateral sources like we used to get in the past. So the only form of concessional financing that now remains is from the international financial institutions such as the IMF, the World Bank, the ADB, etc. So concessional financing is drying up. But we have development needs. So the question is, how do you borrow on non-concessional financing? You have to undertake smart borrowing. It's true that the financial conditions generally have hardened. So you need to think, how best can you get, or how can you get the best rates from this non-concessional borrowing? And I think we have demonstrated in Uganda that we are able to do that. An example that is live and very recent is recently we were able, through some innovative financing, to raise 500 million euros at rates which were much, much lower than ordinary borrowing of resources on non-concessional terms. I think it was north of 250 basis points difference through an innovative financing, what we used to know, what is called the cross-currency repo, where we use some of the domestic securities to get the 500 million euros. And that helped us, not only in terms of the lowering of the interest costs, but also in terms of rebuilding our reserves, because this is a 10-year transaction with a 5-year grace period. And it's true that even the domestic financing conditions were hardening. They were hardening because as Bank of Uganda raised the policy rates, even the yield curve for the securities shifted upwards. So for example, if you were to borrow using a 10-year bond, at that time you'd pay anywhere close to 16, 17%. And it was not prudent for government to continue borrowing at such rates. So that's why government had to look at external sources, and not only that, but also cheaper external sources through innovative financing. So we've managed now to reduce the cost of financing that would have been sourced locally by more than 10 percentage points as a result of this transaction. And also, we have been able to borrow at a much lower rate through the innovative financing. So the hardening condition that Charles talks about, that's how it was partly addressed. The other issue was the vulnerabilities, external vulnerabilities. They mentioned that our reserves were coming down, all right, as one of the reasons for the changed outlook. But now, like I mentioned earlier on, we've been able to rebuild reserves now to close to 4 billion, all right? So we've managed to work on that. Now, in terms of the twin deficits, the government is undertaking significant fiscal consolidation. If I'm not mistaken, the fiscal deficit for 23-24 is about 3.1%, down from about 5%. So this is fiscal consolidation that should lower the domestic deficits, internal deficits, which will be reflected in your balance of payments as well in the current account deficit. So that's how we are dealing with these challenges that made Uganda to be, the outlook for Uganda to be changed from stable to negative. So this is how the government of Uganda has dealt with this. Thank you.
Yes, please.
Thank you. I beg to remain seated. Rona Habwe from Smart 24 TV. I didn't have a question until the acting governor hinted on the private sector stock credit. And I remember during the press briefing at Ministry of Finance, manufacturing was highlighted as one of those sectors that dominated the private sector stock credit, implying that many Ugandans are actually borrowing to manufacture. And in my assessment, these are mostly SMEs. So with the current CBR, are you comfortable that you've set the CBR that is comfortable enough for them to thrive in the economic sense? Thank you.
Okay, maybe before Adam comes in, let me try to respond to that. I think the CBR rate, where it stands now, I think we are comfortable that it should be able to keep the economic growth rate overall close to the 6%, while also ensuring that inflation remains at 5%. That is what our scenarios have generated. So for now, that's what we have. Of course, we live in a dynamic world. Something can change tomorrow. But again, we will consider all that information should there be a change, and then revisit our stance today. Because the stance that we use for determining monetary policy decisions in June 23, right, has changed as we now come to August 2023. So we will keep reassessing those stances. But as of now, the information we have suggests that we should be able to maintain growth around 6% and keep inflation within the 5% target. Adam?
I think I answered it. And in addition to what DJ has said, remember that also manufacturing sector has still other funds from government. Remember, there is a fund in UDB. There's also a fund under Bank of Uganda for SMEs. All those funds are also equally in addition to easing. So for the entire manufacturing sector, therefore, which you are rightly put, it depends on the borrowing to enhance this expansion. You see that this easing, which provides liquidity to the banks to lend, in addition to what the government is providing under different financing schemes, would really help in terms of beefing up whatever investment the private sector is doing in manufacturing.
Okay, we have two more from social media. We have Onan Kataguza on YouTube, who asks, reducing reserve requirement by 9.5%, how efficient is it going to help in economic growth and liquidity in the economy? I'll repeat, how is reducing the reserve requirement by 9.5% going to be efficient, and how is it going to help economic growth and liquidity in the economy? The second question is from Oscar, who asks what your assessment is of the general decline in global aggregate demand, and how soon do you anticipate it to increase?
Thank you, Onet. I think I will leave the question on the global demand to Adam, and then I will just go to the one on the CRR. Maybe as a correction, CRR has not been reduced by 9.5%. We've reduced it by 50 basis points from 10 to 9.5%. So the reduction is 50 basis points from 10 to 9.5%. Now, remember that this is a percentage of the deposits that were in supervised financial institutions that are required now to be kept in as reserves in Bank of Uganda. So when we increased the CRR last year in around June 2022 from 8 to 10%, we locked in close to 650 billion shillings of liquidity. That liquidity was available to commercial banks, but we locked it in. It was no longer available. At that time, we were fighting inflation, we were stabilizing the exchange rate, and now that we've managed to tame inflation and the exchange rate is fairly stable and the growth outlook is softening, we need to reignite or take growth closer to the government objective. So that's why we're saying, why don't we release the amount of money that Adam talked about, is about 160 billion, back into the system so that this is available for lending. Whether it results into lower interest, lending rates is a different matter, but it is available for lending. And that's why we think that that reduction is helping ease the liquidity conditions in supervised financial institutions and helps them also to increase their lending if there's been a shortfall in available resources. So, Adam, can you take the question on global demand?
Yes, on the global demand, I think the question was how the global demand is likely to affect, is it domestic or exports? But anyway, let me put it in the way I understood it. I think if we look at the recent release by the IMF on global economy, it says, that's the report released in July, it projects the global growth to grow by 3%. In April, it had projected global growth in 2023 at 2.8. So that's a bit of an improvement. However, in 2024, it still maintains global growth at around 3%, which means that global growth is anywhere, this year, next year is in the range of it remains around 3%. In good years, it used to be, we are talking about growth of 5% plus. So now the question is, how does this translate into domestic economy? Remember, we export goods worth about $5 billion, at least for the last financial year. And some of these go into the global, go into Europe, like flowers, like fish. There are also those that go into regional market. So therefore, when the global growth improves, the prospects for our exporting also improve. So it automatically means that, yes, if global growth were to remain muted or sluggish, then obviously our exports would also equally remain muted or remain sluggish. So that's really the context we are taking it in. Now, beyond the exports, we also have foreign direct investment. So foreign direct investment come from offshore guys, those who also have Ugandans who are working abroad. If global growth is not booming, their returns in terms of wages they earn becomes less, and therefore what they send back home also decreases. So that is the perspective we are looking at it at the development in the global economy. So overall, it is good. We are saying global growth is going to, yes, subdued but positive. Remember, in the other years, we are worried about recession, but now it is small but positive, which means that, yes, there will be some improvement in probably in our exports this year, and also other flows, including workers' remittances, etc. Leave alone the fact that actually some of the developments in global economy feed into the oil prices and commodity prices, which again affect our domestic economy. Thank you.
Okay, if we don't have any more questions, we're going to bring this to a close. Thank you very much for attending this session, and we will then proceed to, there's one last one. Are there any current risks BOU envisages to affect financial stability? The Deputy Governor mentioned non-performing loans. What are the current levels? Are there any issues with liquidity and capital? Also, what is the status on banks meeting the revised minimum capital requirements? So this is a long one. I will go over it again. This is from Yunus. Are there any current risks BOU envisages to affect financial stability? What are the current levels of NPLs? Are there any issues with liquidity and capital? What is the status on banks meeting the revised minimum capital requirements?
Okay. Is that from
Yunus?
From Eunice? Thank you for those questions. So let me ask the EDS to address these questions. I think they are really likely directed to you. I think you're best placed to answer them. And then maybe Adam can chip in later on. Yes.
Thank you. Towards the tail end of 2022, there was a statutory instrument that increased the minimum paid up capital requirements of financial institutions. And the deadline for compliance was 31st December for the first installment of 120 billion. And then the next deadline was 30th September 2024. Now, because the time between when the instrument came out and the deadline for compliance with the first installment was very short, a number of institutions invoked Section 86 of the Financial Institutions Act 2004, which requires that just in case there are institutions that do not meet the minimum paid up capital requirements and the ongoing capital requirements, they had to submit a recapitalization plan to the central bank. A number of institutions complied then. And indeed, a number also had the resources in their stock. But they had to transfer from one item to another because the instrument talks about minimum paid up capital requirements. Yet when you look at the core capital of a bank, it has a number of items. A paid up capital requirement, share premium, retained earnings. So they had to transfer from one of those items to paid up. And the law gives a period of 6 months. Come 30th June 2023, the institutions that did not comply then made efforts to comply. And there may be a few challenges here and there, but still, we still have a time frame of 30th June 2024 within which to assess the compliance of institutions with a statutory instrument. There was a question of non-performing loans that came through. I don't have the figures right now, but the aggregate has been around 5% since the beginning of the year, and I haven't looked at the numbers for June, but I haven't seen anything that would suggest that number would change significantly from 5%. Thank you, Mr. Chairman.
Thank you very much. We are going to bring close to this session. Thank you, and we will stay behind. A few of us will stay behind for the Luganda reading. Deputy Governor and your team, thank you very much for the statement. You're going to
alipoota ekwata ku byensimbi ey'omwezi ogw'omunaana omwaka 2023 ng'omumyuka wa gavana bw'ayogedde nti olwaleero akakiiko ke twakazaako erya Monetary Policy Committee kakkakanyizza akabonero aka Central Bank Rate okuva ku bitundu 10 we kabadde emyezi ebiri egiyise ne kabiteeka ku bitundu 9 n'obutundu 5 buli 100, era gavana atangaazizza nti okutwaliza awamu enkyukakyuka y'emiwendo gy'ebintu omwezi oguyise emyezi egiyise eraze nti ezze ekkakkanira ddala, era n'anokolayo nti inflation egudde okuva ku bitundu okuva ku bitundu 4 n'obutundu 9 buli 100 okutuuka ku bitundu 3 n'obutundu 9 buli 100, ate ng'emitendera gyonna egy'enkyukakyuka y'emiwendo gy'ebintu gikkakkanye okuva we gibadde emyezi egiyise. Era gavana awadde ensonga nti ekyo kivudde ku kuba nti banka enkulu ya Uganda awamu ne Ministry y'ebyensimbi zibadde zanywezaamu mu byensimbi, era bw'otunulira ensimbi ya Uganda n'amawanga amalala nazo zibadde zenywezezza, ate bw'otunulira ebbeeyi y'amafuta emmere eyo nayo yeeyongera okukkakkana, awamu n'okuba nti twafuna okukkakkanamu mu bantu abeetaaga ebintu ebiwerako mu ggwanga oba kye twakazaako domestic demand. Era gavana n'alambulula nti kino okukkakkana kw'enkyukakyuka y'emiwendo gy'ebintu kijja kweyongera mu myezi egijja, kubanga bwe bakubye ettooki mu maaso balaze nti okutwaliza awamu obungi bw'ebintu ebiva mu nnimiro bijja kweyongerako, abantu ebbeeyi enkyukakyuka emirimu gy'ebintu gye bali basuubira okwambuka nayo balaga nti batandise okulaga nti ejja kukkirira, awamu n'amafuta n'emmere nabyo bijja kweyongera okukka mu myezi egijja mu maaso. Era gavana alambuluddeyo n'agamba nti n'amawanga gali gannaggwa dda nago olw'okuba nti ganywezaamu kukuba oba mu nkola yaago eya monetary policy, kyo nakyo kijja kweyongera okuba nti kikendezaako ku miwendo egyo. Ate ng'ekyo kiyinza okuvaako nti bannaffe bamusiga nsimbi mu Uganda bayinza okwagala okutwala ensimbi zaabwe mu mawanga amalala, naye gavana akakasiza bannayuganda nti ekyo tekijja kukosa mpaanyisiganya ya ssente za Uganda n'amawanga amalala, kubanga banka enkulu eya Uganda eyina obumanyirivu okulaba nti ekyo tekikosa. Gavana n'alambulula nti okutwaliza wamu bwe bakubye ettooki mu by'omu maaso ebikwata ku nkyukakyuka y'emiwendo gy'ebintu, balabye nti okutwaliza wamu bwe batunuulira mu myezi egijja mu maaso nti ebintu ebiyinza okukosa enkyukakyuka y'emiwendo gy'ebintu eyo biraga nti bigenze bikkakkanira ddala. N'olw'ensonga eyo akakiiko kye kava kasazeewo olwaliro kakole ebintu bya mirundi ebiri, nti kasazeewo okukkakkanya akabonero ka Central Bank Rate okuva ku bitundu 10 wekabadde emyezi nga 6 egiyise ne kakkakkanyizibwa okutuuka ku bitundu 9 n'obutundu 5 buli 100. Ne bakola n'ekirala nti bw'otunuulira ssente banka ez'ebyobusuubuzi ze zitereka wano oba kye twakazaako cash reserve requirement mu Lungereza, ezo nazo zikkakkanyiziddwa okuva ku bitundu 10 gye zaali ziwanikiddwa mu mwezi gw'omukaaga 2022, nazo ne zikkakkanyizibwa okutuuka ku bitundu 9 n'obutundu 5 buli 100. Ebyo byonna gavana alambuludde nti bijja kwongera obungi bwa ssente buli mu banka ez'ebyobusuubuzi, era be bakuba ttooki mu maaso nti ekyo kijja kweyongerako okussa ssente bannayuganda kwe beewolera mu banka ez'ebyobusuubuzi. Gavana ku byenfuna by'eggwanga alaze nti wadde nga mu myezi 6 egiyise byakenderamu ku sipiidi kwe bibadde bitambulira, naye yalaze nti akakiiko bwe kakuba ttoosi mu maaso kalaga nti ebyenfuna by'eggwanga bijja kulira ku bitundu 5 n'obutundu 3 buli 100 mu mwaka gw'ebyensimbi 2022-2023. Bwe batunula mu maaso 2023-2024 batunuulidde nti enkulaakulana y'eggwanga ejja kubeera wakati w'ebitundu 5 n'obutundu 6 buli 100. Naye ng'egwo guli gutyo, gavana atangazizza nti muyinza okubeeramu obumulumulu obuyinza okukosa sipiidi ebyenfuna by'eggwanga kwe binaakulira. N'alambululayo nti singa ebyenfuna by'amawanga gali gannaggwa dda biba tebikuze nga bwe bisuubirwa oba ne beeyongera okunyweza ebyensimbi zaabwe, ekyo kiyinza otukosaamu katono. N'alaga nti singa n'amawanga ago tegettanira nnyo bintu bye tutundayo, ekyo nakyo kiyinza okwongera okutukosaamu. N'alaga nti ne Gozlin ali mu ntambuza y'ebintu mu mawanga ag'enjawulo, ng'ekyo kyesigamye ku butuubagiro obuli wakati ng'okugezaako aka Ukraine ne Russia, ebyo naye biyinza otukosaamu katonotono. N'alaga n'ekirala nti okutwaliza awamu nti singa amawanga gali gannaggwa dda nabo beeyongera okunyweza ebyenfuna byabwe, kyo nakyo kiyinza okuziŋŋamya ebyenfuna by'eggwanga mu ngeri emu. Naye kyasinze okusimbako essira nti bwe bakuba ttooki mu maaso 2023-2024 eraga nti ebyenfuna by'eggwanga bijja kukula nga paka ku bitundu wakati w'ebitundu 5 paka ku bitundu 6 buli 100. N'alambulayo nti n'ekirala Uganda ku nkola eya anti-money laundering, countering financing of terrorism, twali tuteekeddwa ku lisiti ey'ekikuusikuusi olw'okuba nti waliwo ebintu ebyali binokoddwa ebitannakolebwako. Naye gavana alambuludde nti okutwaliza wamu ebintu ebyo ebyayina oba banka enkulu ya Uganda byayinako obuvunaanyizibwa ebisinga bikoleddwako, era n'alambululayo okutwaliza wamu nti waliwo kakati ekitongole ekyeyimiridde ekikola ku nsonga ezo. Ne balambulayo nti bateekawo n'enteekateeka enatunuuliranga banka ez'ebyobusuubuzi mu nkola eyo, ate awamu n'okuba nti bannyonnyola abantu kiki ekirina okukolebwa. So mu nkola eyo gavana n'alaga nti wakati ku bintu 22 ebyali bisuubiddwa okukolwa, ebintu 2 bikoleddwa era nga n'ebibiri ebisigaddeyo era nabyo bikolerwako okusobola okujja lisiti okusobola okujja eggwanga Uganda ku eyo lisiti gye bakazaako mu Foot grey list oba lisiti ey'ekikuusikuusi. So mu kutwaliza awamu byebyo gavana byayogedde ku kwa lipoota y'ebyensimbi mu mwezi ogw'omunaana 2023. But you want questions in Luganda? Those ones are difficult to go, so let us address.